guys, welcome back to Tax Q&A. Did you know that this year the US markets have outperformed the Indian markets? The Nifty 50 index has grown by 14.6%, while the S&P 500, which tracks the top 500 US companies, is up by more than 28%. And it's not just the US. Take the Chinese markets for example. They surged by 24% just after mid-September. Clearly, these markets don't really move in sync with ours. They're not highly correlated. That's exactly why more investors are starting to look at foreign markets. When you invest globally, you're not putting all your eggs in one basket. So, if one market underperforms, others might add a balance. And now, thanks to technology and globalization, investing globally has never been more convenient. So today, we decided to look up some of the most common questions around investing in foreign assets and their taxation. So let's get started. Anything that holds your money in a foreign country counts as a foreign asset. This could include investments like real estate, stocks, or any other capital assets outside India. Even a bank account abroad is considered a foreign asset. Well, there are several ways to go about it. One is that you directly invest in foreign stocks. This could be done either via Indian brokers that allow foreign investments, or you can open an account with international brokerage platforms that give you access to global markets. While this route provides more control, it requires more research, and you will also need to stay up to date with international markets and events happening in those economies. So, a simpler option could be to go through an Indian mutual fund or ETF that invests in overseas markets. These funds give you global exposure without the hassle of individual stock selection. See, every investment is part risk and part return. When it comes to foreign stocks, one of the key risks is currency fluctuation. The value of the Indian rupee compared to the currency of the country where you're investing can impact your returns, sometimes positively, sometimes negatively. Then there's the knowledge gap. Foreign markets and companies might not be as familiar as local ones, so understanding their performance and financials often takes extra effort. Another factor is geopolitical or economic risks. Things like political instability can affect the market in ways you might not foresee. And one more, not exactly a risk, but definitely something to think about, regulations and compliance. Investing abroad means you're dealing with rules and tax requirements from not just one, but two countries. Okay, now that we know about investing abroad, we need to move to the taxation aspect. If you're an Indian resident investing in the foreign markets, there's additional compliances that you need to take care of. Unlike domestic assets, where you typically report only when you realize profits or losses, foreign assets are treated differently. With foreign assets, you're required to report not just the transactions, but also the holdings in your ITR. This includes everything: real estate, stocks, or even a foreign bank account. In case you fail to do so, you might face a penalty of up to Rs 10 lakhs under the Black Money Act. However, this year's budget brought in some relaxation to this. The penalty will not be levied if the aggregate value of assets does not exceed Rs 20 lakhs. One more thing, if you're investing in Indian mutual funds or ETFs that have allocations to foreign equity, you don't have to report the holdings. See, first of all, there are two things: disclosing your foreign assets and reporting your foreign income. Both require you to fill out specific sections in your ITR, Schedule FA for foreign assets and Schedule FSI for foreign source income. For disclosing foreign assets under Schedule FA, you need to start by selecting the type of foreign asset you hold. Then, you will be required to provide detailed information. For example, if you hold foreign stocks, you will need to enter details such as the company's name, its address, the value of your investment, etc. When it comes to reporting foreign income under Schedule FSI, you will begin by specifying the country where the income was earned. Along with that, the TIN, taxpayer identification number, or your passport number. Then you'll enter the type of income you've earned, whether it is salary, rental income, or capital gains. The amount earned in Indian rupees, of course, and details of any taxes paid on this income in the foreign country. Apart from this, you also need to report the foreign income under the respective schedules in the ITR, just like you report your domestic income. This actually depends on how you're investing in those shares. Like I said earlier, you can either directly buy foreign shares or invest via international mutual funds and ETFs. The taxation will differ depending on the route you choose. For foreign shares, the gains will be taxed at 12.5% if held for more than 24 months, and if held for less, they'll be taxed at the applicable slab rate. The rules around foreign ETFs and MFs have changed quite a bit over last 2 union budgets. As per the latest rules, long-term gains from both of these will be taxed at 12.5%, while short-term is taxable at slab rate. However, the holding period for ETFs, because they're listed in India, will be 12 months, whereas that for mutual funds will be 24 months. The rates would differ depending on when these were bought. You can take a screenshot of this table for reference. When you earn income from another country, it's likely that the government of that country is also collecting tax on it. Now, since you're a resident of India, your global income is taxable here as well. This creates a situation where you might end up paying taxes twice in the same income, once abroad and once in India. To avoid this, India has signed double taxation avoidance agreements (DTAA) with many countries. If you've already paid tax in the foreign country, you can claim a credit for that amount while filing your taxes in India. For example, if you earned dividend income in the US and they deducted some amount as withholding tax, you can claim this amount as a credit against your tax liability in India. For this, check the details in Schedule TR, Tax Relief, in ITR. This section auto-populates the income details from scheduled FSI and will reflect the tax relief that you are eligible to claim. Additionally, don't forget to file Form 67 on the ITD portal before submitting your ITR. Filing Form 67 is mandatory to claim foreign tax credit. Otherwise, your claim might be disallowed. And with that, it's a wrap. If Google search is too much work for you and Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. Those economies. Wrong.
ये गलती हो गई वापस कर ले
एक और speed.
Actual food.
Again, please. Chal, next question. Mr. Nope.